The EV automaker closing the day down nearly 10% in today's trading session after reporting earnings last night. Analysts expressing concern over the automaker's price cuts and the impact to margins. Tesla is Cathie Wood's top holding in her ARK Innovation Fund, her flagship fund. And Cathie Wood joins us now exclusively. Cathie, it's so great to have you on the show. Thanks for being with us.
Thank you, Morgan. Happy to be here.
So much to discuss with you, but I do want to start with Tesla. Your reaction to those results we did get yesterday, and specifically the fact that the operating margin dropped pretty dramatically to 11.4%, certainly in focus for trading today. Does this change your outlook or your thesis around Tesla?
Not at all. In fact, curiously, we want Tesla to scale its units because each one of them now represents the potential for a RoboTaxi and a RoboTaxi fleet. Now, Elon says it's possible that he could launch that fleet this year. We think it's more like last year. But the RoboTaxi fleet is really going to be, or the RoboTaxi service is going to be, from a margin point of view, more like a SaaS business. And so we think that it's very smart to maximize units because they have so much option value now.
Yeah. I mean, but we've been hearing about the RoboTaxi fleet for some time. There's a lot of regulatory barriers to all of that, and certainly technological barriers involved too. So how soon can we actually see that realized? And given the fact that you tweeted earlier today that you've got a new valuation assessment of Tesla coming out, how does that fit into your price target for the stock going forward?
The price target for our stock, and I think it's just hitting now, for 2027, because we do have a 5-year investment time horizon, is our expected value is roughly $2,000, and that's within a range of $1,400 to $2,500, our bear and bull case. Now, just Morgan, on the regulatory side, I actually think regulations are working in Tesla's favor. For, I think, roughly 3 decades, the number of auto fatalities in the United States fell to the low 30,000 range per year. And they've turned around in the last 5 years and moved up to 45,000 plus. And I think the pressure is on the National Highway and Transportation Safety Association to change something. So it is looking carefully at Tesla's data. And during Investor Day, Tesla released some data that we don't think many people paid enough attention to. The most important one is that with full self-driving, a Tesla vehicle gets into an accident every 3.2 million miles. And that compares to 1 every 500,000 miles for the average car on the road.
Okay, so Cathie, hold on. Good afternoon, It's John Ford. I just want to clarify, did you say a $2,000 per share price target? Tesla right now is under 200 a share. So even if you were to 10x that would be an over $5 trillion market cap. Is that what you're saying?
That is what we're saying. We think that the RoboTaxi opportunity globally will deliver $8 to $10 trillion in revenue by 2030. And is one of the most important investment opportunities of our lifetimes. Okay. And I think one of the reasons for that is it is going to save lives. 80 to 90% of auto fatalities and auto accidents are caused by human error. And autonomous driving is going to take away the human error, we believe.
That's a lot of ground for that stock to cover in 5 years. It'll be exciting to watch either way. I want to get into some other names. You've had certainly some hits this year, including today. What's the stock that had earnings today that's one of her top holdings and spiked?
Iridium.
Iridium. Up, yes. What was it, 10, 11% today after earnings? But some misses too over the years. A couple of years ago, you joined us on CNBC and told us about Invitae, I think it is, in molecular diagnostics. It was around $32 a share. that day. You said it was one of the most important companies in the genomic revolution. I think it's around $1.24 now. What happened there with your evaluation of that company?
Well, a couple of things. One, they moved into a lot of different projects, and they have brought in new management to streamline. We hit into the buzzsaw of a 20-fold increase in interest rates, which is a killer for long duration assets. And our life sciences stocks, Invitae, one of them, have been hurt very badly because they are early stage. They are often burning cash, and the market really assassinated stocks that were long duration. And genomics, or what we call it now, multiomics, is one of the longest duration themes we have.
Okay.
A lot of our genomics names are in that category. But we do believe the breakthroughs that we're seeing, thanks to the convergence of DNA sequencing, DNA, RNA, protein sequencing, and artificial intelligence, are already delivering cures for disease. And so we still hold Invitae. And if anything, during this last 2 years, as the life sciences stocks have been pummeled, we have been increasing. It's been hard work to keep our percentage in the flagship portfolio at roughly 30%, because we think that the breakthroughs are going to be life-saving. So, and we're getting evidence in sickle cell disease, beta thalassemia, ATTR. These are being cured by gene editing today. And we're seeing the promise potentially of diabetes being treated by gene editing in the future.
We did just mention Iridium. I do want to ask you about ARC-X, the Space Exploration and Innovation ETF. That name is the top holding in that ETF, but a privately held name. As we're talking about Elon Musk here, SpaceX, huge historic flight test this morning with Starship. It failed mid-flight, but
Yes.
basically ushered in a new milestone in this commercial space era. Want to get your thoughts on that, and want to get your thoughts on how you're approaching that space ETF, which has stirred some debate about just how spacey, in general, the names in that ETF have been.
Well, yes, today was historic. And if you looked at all of the people witnessing that takeoff, and as I understand it, SpaceX actually exploded the rocket because of an engine failure. It's historic. They were cheering. They learned so much. It didn't explode while it didn't explode until minutes through the launch. And I think lots of lessons learned there. And, as we were watching it, we're saying, okay, we're going to make it to Mars. We are going to make it to Mars. So very, very exciting, we think.
All right. Well, Cathie, stay with us because we're going to take a quick break. But there's so much more we want to speak with you about. So on the other side of this break, we're going to get your views on the broader market, inflation, and so much more. Stay with us. Closing bell, overtime. We'll be right back. Invest CEO Cathie Wood is still with us. Cathie, thanks for sticking around. I want to take a bigger picture view here. You did just release your Q1 2023 quarterly report, and we've also seen the majority of your funds outperform the S&P to kick off this year. But it does look like net it's been outflows. So how are you categorizing performance, and how is this dynamic impacting, if it is at all, the way you're thinking about your products?
Actually, the outflows have been minimal. In fact, I think our flagship ARKK has been inflowing year to date, and the others have had some small outflows. Given the amount of caution we see in the marketplace today, we are actually gratified by our asset retention. We're seeing massive cash positions. The ratio of stocks to bonds hasn't been this low since I think it was since 2009. And so this is an environment, this kind of cautious environment to see inflows at all, which we are seeing in ARKK, even if not in some of the others recently. Our asset retention in the last 2 years, I think many in the industry would say has been stunning, given how difficult the environment has been for long duration assets.
Let's talk a little bit about ARK Venture Fund, which you launched last fall, ARK VX. The impetus for this fund and what it means for more investors being able to get into the private markets, especially as we have seen the IPO pipeline seize up and the SPAC market, which was so crazy a couple of years ago, basically fall off a cliff. And also the fact that you have cut those fees recently as well.
Yes, well, the impetus of the fund, we've been researching private companies since the firm began. We have to, because we're focused on nothing but disruptive innovation. But we wanted to be a part of democratizing the venture capital world, opening it up to retail investors who have been frustrated by the need for accreditation, at least financial accreditation in terms of income and asset threshold with the traditional venture world. And so our venture fund you can get into for $500. It's ARKVX. And for $500, we have quarterly liquidity up to 5% of NAV. And we think that's an attribute that our retail investors like as well. And we just think that the amount of innovation that's taking place today is astonishing. And we wanted to start a venture fund during downtime so that we can be part of the solution to the problem that they are finding themselves in right now, which is a venture capital funding drought.
Yeah. Cathie, I wanted to get your thoughts also. You mentioned that rising rates hammered some of the stocks that you've bought in 2022. How are you modeling the possibilities for this debt ceiling debate? Even if we don't get a default, if we get something closer to that 2011 scenario where things look iffy, what's that going to do to the category of stocks that you hold?
Well, I don't think it'll be, if they defaulted, it wouldn't be good for any market. I'm happy to hear more politicians from both sides talking about what a disaster it would be. I'm happy to hear that come out of their mouths, and hoping therefore that there is some rapprochement here, and believe there will be. We have a 5-year investment time horizon. This will sort itself out, and maybe in the meantime create more opportunities for us. As you know, during risk-off periods, we concentrate our holdings towards our highest conviction names. We're quite concentrated right now, but that doesn't mean we wouldn't concentrate more. So again, it's a short-term phenomenon, and we think they'll work it out as they always do. How messy it will be, I have no idea.
Yeah, you've been on our air a number of times to talk about the disinflation dynamic. Given the fact that we do have a Fed that is potentially, at least the market's pricing in the likelihood that we're going to see one more rate hike next month, so much debate about recession, the breakdown of the dollar, a number of other dynamics that are really causing cross currents in the market. Your take, especially as you did release this quarterly report, your take on the markets right now and where we're headed into the second half of the year?
Well, I think the markets are leading the Fed. And I was struck today to learn that the 1-month Treasury bill yield is 140 basis points, so 1.4% below the low end of the Fed funds rate. I remember in 08-09, the Treasury bill rates were an early indicator of how quickly the Fed was going to ease once it realized how much trouble we were in. And in terms of the bank crisis, I don't think it's over. I don't know what's going to make deposit flows back into the banking system. So that's a problem. So I think that what killed long duration strategies, including the bond market last year, it had the worst performance since the 1700s. Was a 20-fold increase in interest rates in 1 year's time. Never happened before. And I think there are going to be ramifications. I think the market's saying we're probably either in or moving close to something harder than just a soft landing, which seems to be the consensus view out there. And I think that will turn interest rates and continue to push inflation down. We think that the greater risk here in the next year, next 6 months to 9 years, is deflation, not inflation. And some of it's good deflation. Tesla's price cuts are good deflation. They can cut prices because their costs are coming down. And they can respond to weak consumer demand because their costs are coming down. That's good deflation. But there are a lot of industries that cannot adjust their prices down because they're mature. And so we think it's going to be problematic. And again, deflation will be the watchword, we think, more and more often during the next 6 months.
Yeah, we just went full circle on Tesla. So I think we're going to leave the conversation there. Cathie Wood, great to have you on. Thank you so much for joining us today.
Thanks so much.
Up next, Mike Santoli breaks down the unusual outperformance of J.P. Morgan versus the regional banks and what that could mean for the rest of the banking industry. We'll be right back.